name is Paige Showerman, and I'm the marketing manager for Association Reserves, and I'll be serving as your moderator for today. Today's webinar is part of a series of monthly webinars that we host every year. Each quarter, we'll have a series of 3 webinars: Fundamentals of Reserves, followed by Reserve Funding Methodologies, and concluding with a special Ask a Reserve Specialist session. So if your questions aren't answered here today, we'll be dedicating a special webinar later on, which will give our audience a chance to submit whatever questions they'd like and have them answered live by a subject matter expert. I believe that our next webinar for that is in November, so be on the lookout for that email. Today's class, Fundamentals of Reserves, is a 1-hour webinar designed to help you clear through the clutter and misinformation about reserve studies and help you get right to the important issue: enough cash on hand to perform your major common area projects in a timely manner. It is important for board members and managers to have a firm grasp on the subject to prevent careless mistakes that result in deferred maintenance, cost overruns, and special assessments. I believe you'll find that today's class will have been a great investment of your time. Due to the number of people attending, everyone has been muted, but you can ask questions at any time by typing your question in the question box at the bottom of your control panel. Please make sure to hit the Q&A button and not the chat button. Our Q&A time will be during the last 15 minutes of the broadcast, and we'll get to as many as time allows. For our licensed association managers attending, this webinar is approved by the State of Florida Department of Business and Professional Regulation for licensed community association managers for 1 CE credit related to the CAM certification. I will email certificates of completion to all attendees within 1 week. Please keep in mind that the credentialing committee does track how long you're on the webinar. With that said, we don't want to give the impression that this course is only for managers. Board members, committee members, and residents will also learn a great deal about reserve budgeting and planning and come away better prepared to lead and serve their communities. Also, we'll be providing copies of the slides for today's presentation, as well as a recording of the class. So if you have any colleagues or friends who couldn't make it today, please feel free to pass those along. And now I'd like to turn the floor over to Will Simons. Will?
Paige, thank you very much. All right, everybody, thanks for joining us today. And let me kick things off here. Okay, so again, thanks for joining us. My name is Will Simons. We've been doing these webinars now for quite some time, and it's a pleasure to be with you virtually. I'm going to say hello on camera here just in the beginning, and then I'll turn my camera off during the majority of the class so everybody can focus on the slides for the presentation. So, kick things on here.
Here you are.
Okay, all right, sorry about that, folks. A little technical difficulty on my part. Let me introduce myself and our company a little bit more. Hopefully this audio is going to come through okay. Seems like my connection might be a little bit shaky. Can you still hear me now?
Yes, you are good.
Okay, all right, so let's back to the beginning. Okay, Association Reserves, we've been around since 1986, and we are one of the largest, if not the largest, reserve study provider in the U.S. Our office here in Florida has won 10 consecutive Florida Reader's Choice Awards from the Florida Community Association Journal. And I'll introduce myself a little bit more here and then talk a little bit more about our team. So personally, I'm a credentialed reserve specialist. I've been doing this for a little over 15 years now, completed thousands of reserve studies in my career. I oversee all of our clients and staff all over the state of Florida, and I've got a lot of experience working with a very wide range of different property types. I'm sure there's going to be some questions today about the new legislation that we have in Florida, Senate Bill 154. That is something that I have a lot of direct involvement with. We worked with a lot of the stakeholders as far as the DVPR, elected officials, the Florida Engineering Society, a lot of the new legislation that we have in the state these days. I've been very involved with over the last 2 years or so. I do want to make a point, and I'll reinforce this again at the end, that with respect to any of these questions that may come up, I'm not an attorney. I would definitely recommend that you do consider talking to your counsel if you have any new questions about the law. And I do want to make clear this particular course, this fundamentals course, is not intended to be a complete overview of the new legislation. I did get some emails in advance for today talking about questions and applications of the new bill, we do actually have a whole separate recorded webinar on that topic. So that is something I can make available, or Paige, you can help me out. We can send a recording of that later on, but I might have a little bit of time to touch on that in the Q&A, but really the main focus for today is on the fundamentals. Again, this audience that we have today is meant for condos and HOAs. So the new legislation that we have is really specifically just for condos, but yeah, we'll talk a little bit more about that as we go along. Okay, let me tell you a little bit about our Florida staff. We are statewide. We actually need to update this slide a little bit. We're now up to 20 people in total. Got thousands of different association clients all over the state. We work with a large percentage of condos, but also a lot of HOAs, timeshares, and other types of properties. Amongst our staff, I think we've got a very good broad skill set, talent base with staff members that have degrees in civil engineering, mechanical, industrial, construction management, business, accounting. Also, one of our more recent hires is a full-time structural engineer, professional engineer with lots of experience in forensic engineering, particularly in Florida. At the moment, we have 5 of our staff that are credentialed as reserve specialists, and we have quite a few more who should be earning that credential here in the next year or two. So bottom line is we have a lot of experience in many different domains, but our focus at this point is exclusively on preparing reserve studies. So, all right, so this is what we're going to cover today. The course really just has these 2 basic sections. The first portion in the beginning here is this kind of fundamental question: what are reserves? Okay, and then we'll spend the majority of the class talking about reserve studies and how these studies are used by community associations to make sure they're on the right track with regard to long-term planning. And of course, we can talk about some examples of what can go wrong, what types of things can happen to associations that don't have adequate reserves. In fact, our whole other class, the reserve funding methodologies, has a lot more to say about that. So with that started, or with that as our intro, last slide before we kick in here, I'd just like to highlight this one. I think this mindset, this attitude is very prevalent in the community association world, particularly when it comes to long-term planning. So if you're a manager out there, if you're a board member, and this is the kind of face you see at budget time when it's starting to talk about reserves and thinking about the future, this is for you, right? This is pretty obvious. The guy's got his eyes closed, fingers crossed, this kind of pained look on his face. So if there is one message that I want everybody out there to remember from today's class, it's that we all need to go out there to the communities that we work with to help them get over and get around this mindset, right? Whether you're a volunteer, whether you're a professional, it is our collective responsibility to educate the people around us. And that's why we're doing this class here today. So thanks again for being here. All right, we'll start with, again, this basic question: what are reserves? Okay, so if you've been in the field for a while, if you've worked with associations or been involved with budgeting, I think this first part is going to be a little bit elementary. But if this is new for you, if you're not used to drafting a budget, this is your first year on a board, I think we'll just spend a couple of minutes talking about the 2 main aspects of any given association's budget. Okay, so basically your budget can be categorized into 2 main sections, what we call the operating fund and then the reserve fund. First up, we'll talk about the operating fund. Okay, so that money is essentially there for the routine costs of running the business of the association. Okay, these are going to be the daily, weekly, monthly expenses for things like utilities and insurance and payroll, preventive maintenance, so on and so forth. So if you think of things in personal terms, you can think of the operating account sort of like an individual's checking account, right? This money is unrestricted. That means that you can spend the money on any bill that the association has to pay. Typically, that money will be spent in the same year that it's collected. So what that means is that if you've designed a good budget, you really shouldn't have much of a surplus or a deficit at the end of the year. Ideally, you spend all of the money that you collect for that operating side within the same fiscal year that it's collected. Okay. Now, that is different from reserve funds in a couple of important ways. Reserve funds, that money is there for the long-term expenses that associations have to pay for, right? So some of these things may not happen for 5 or 10 or 25 years at a time, But when they do, these are often some of the biggest bills the association will ever have to pay. So reserve money can be used for things like roof replacement, building painting, pavement resurfacing, many other projects that we'll talk about later on. Okay, some of the other differences between operating and reserves is that reserve money is restricted. Okay, what that means is that once you put $1 into a reserve account, it can only be spent on specific things, not any random project, any other cost or bill the association has to pay for. Now, another major difference is that in contrast to the operating fund, reserve money will accumulate, sometimes taking place over many, many years, building up an account balance until it needs to be spent on its intended purpose. So going back to our analogy, in that way, the reserve account functions a lot more like a savings account, maybe even a college fund or a retirement fund for an individual or for a family. Okay, on this slide here, I've got a very short excerpt from our Florida statutes. Specifically, this is a section of the statute 718, what we call the condo statute. This red portion here is what I've highlighted to talk about what associations must be reserving for. So if you look at that section, the statute requires that condo associations reserve for 3 things in particular, and then they add in this one general definition. Okay, so the 3 things they name specifically being roofs, painting, and pavement resurfacing. And then this general catch-all definition at the end is for any other item with a replacement cost greater than $10,000. Okay, so just to pause for a second. Again, this is the statute 718, which has been around a long time. And it is not, I'm not at this point going into the special structural integrity reserve study requirements. That is a new set of requirements that kind of go above and beyond what is required by 718. But just so everybody understands, if you are a condominium in Florida, whether you're 2 stories, 3 stories, or 20 stories tall, you're still subject to 718. So even if your association is not also now responsible for a structural integrity study, at baseline, you still have to be funding for these things, right? Roofing, painting, pavement, anything over $10,000. Okay, for those of you coming from the HOA side of things, this is a short excerpt from statute 720, which actually has even less to say about what associations should be reserving for. Okay, so unlike the condo statute, the HOA statute 720 does not have that sort of checklist of items that need to be included. Instead, all it pretty much says is that, look, there are certain things that associations are responsible for, and if you don't have reserves, then that could result in a special assessment. Okay, so really not a very helpful guideline there. But the good news is that there is actually a much more realistic, much more thorough way to go about defining what any association should be considering in its reserve plans. We'll talk about that in just a little bit. All right, for now, I just want everyone to keep this sort of basic definition in mind. Reserve money is there for associations to save over a long period of time for major repair and replacement projects. Now, it's important to notice what I didn't say there. Okay, I did not say that you could spend reserve money on capital improvements, on paying an insurance deductible, really for any other purpose. This reserve money is scheduled for specific things. And I'll give you an example. Let's say there's an association out there that does not currently have a playground, but all of the residents really, really want to put one in. I think that's a good idea. Now, that might be a totally worthwhile thing to do. It might be of great benefit to the community, but they couldn't use reserve money for that. The reason is they're adding a new element to the association, and that would have never been considered in any of their prior year budgets. So that means any prior reserve contributions, any existing funds on hand, would have never taken that new cost into account. So again, might be a good thing to do, good business decision for the community, but the initial expense would have to come out of some other means, right? There's some kind of capital improvement fund, maybe a surplus in operating, but not using reserve money for creating something out of nothing. Okay, time to switch gears. Again, that was a very kind of brief, basic introduction talking about the 2 sides of the budget. Hopefully that's a good review for most of you out there. But let's talk about reserve studies and how these are used by properties to prepare their annual budgets. So the first thing to do here, I think, is just establish the definition of the term reserve study, which comes from National Reserve Study Standards. Now, these standards have been in place for just about 25 years now, and the standards define a reserve study as a tool or a document, but it's a tool that does a couple of important things. First, it identifies the current status of the reserve fund. And then secondly, it provides a funding plan that will give guidance about how to deal with future expenditures. Okay. So again, notice what I didn't say. A reserve study is not an insurance appraisal. It's not a turnover study. It's not an engineering report, right? It is a very particular document that contains very specific content regarding both the physical and financial elements of a community. There are 3 types of reserve studies. So if a property has never had one done before, then it's going to start with what's called a full reserve study. So in that type, the provider is creating everything totally from scratch, right? It involves a thorough site inspection, taking measurements, taking photos, otherwise gathering up all of the raw data that will eventually turn into the component list for that property. Now, after a full study has been done, there are 2 types of updates that can be done after that. The first type is called an update with a site visit, or a level 2 study. In that case, there is a new site inspection that's taking place, but it will be based off of the existing component list. The idea being just to identify any significant changes in life expectancies or costs based on the current conditions at the property. Okay. Now, there are some states that require these types of updates at specific intervals. Very commonly, it's every 3 years, or maybe every 5. Generally speaking, the best practice in the industry is to have a new on-site visit done at least every 3 years or so. And I would say it's especially true in the last couple of years in Florida, where we've had a lot of hurricanes, a lot of changes in market pricing for components due to COVID. There's just a lot of change that's taken place in the market. And so if it's been more than a few years since your last on-site visit, something you should very much consider. Okay, but if you have had one done more recently, then there is another option for you, which is called an update with no site visit, which is exactly what it sounds like. Still a whole new reserve study document, but instead of conducting a new inspection, in this case, the provider is just corresponding with the board of directors or the property manager to find out what projects have taken place or what new information is now available since the last time somebody was on site. Okay, there are 2 parts to this process, 2 parts to a reserve study. First of which is the physical analysis, which is then followed by the financial analysis. Okay, so the physical analysis portion of the reserve study, this is the part where somebody comes out to do that on-site visual inspection of all the common areas of the property. Should include everything from the roof to the mechanical rooms, the amenities, the lobby, interior common spaces. Basically anything and everything that the association is responsible for needs to be evaluated. So again, we're taking measurements and photos, we're quantifying things, we're also documenting model numbers and serial numbers for equipment, basically doing whatever else it takes to gather up those data points, those observations related to each component, which we then use to determine the life expectancies and ultimately the replacement costs for those things. Okay, so during this physical analysis, it's usually very worthwhile to try and meet with a representative from the property. That could be a board member, it can be a manager. The idea there is just to try and collaborate with the representatives of the property to gain from their insight and their experience of having worked there. And we get that question all the time. When we're scheduling a site inspection, somebody will say, well, can we budget some time, or are you guys on your own? And I always would encourage our staff to make extra time for those types of meetings. Very, very valuable, even if that's just with a maintenance person who's been there for 20 years. We can learn a lot about the history of the property, which is very, very meaningful to the outcome of the study. Okay, the second part of the process is that financial analysis. This is the part that takes place back at the office, where we organize all that data, we compile it, we start analyzing it. We'll be doing research for particular cost history or project history to understand when things have been done. We compare that information with our experience working at similar properties, and then we kind of fill in the gaps. We start to draw some financial conclusions and actually put the recommendations for that client together. Okay, there are 3 outcomes to a reserve study. We'll go through these one at a time. the first outcome, the first thing you get from a reserve study is the basic building blocks. It's the component list. Okay, so I've been using the word component a little bit here and there, and I want to just define what we mean by that. So the word component in this context really just means some instance where the association is going to spend money. Okay, so it can be a reserve component, could be a roof replacement project. It can be resurfacing the swimming pool. It could be remodeling the lobby. But the idea is that for each and every component, there are three key pieces of information that need to be determined. The first of those being the useful life of that component. What we mean there is its overall lifespan. In other words, how long is it going to be in place from start to finish, either from when it was originally installed or when it was most recently replaced, until that needs to be done again. Okay. The second value, the second estimate, is the remaining useful life. Now that number is always determined relative to a certain point in time. So for example, let's say we're working on a study right now and we have a component that we're giving a useful life of 10 years. And as of this fiscal year, it's 3 years old. And typically in that case, we would then be saying that the remaining useful life should be 10 minus 3, about 7 years old, or excuse me, 7 years to go before the next replacement. And then lastly, we're going to come up with an estimate for replacement cost. And we get asked from time to time if something needs to be completely replaced in order to justify it as a reserve component. So to be clear, you don't always have to be fully replacing something to justify spending reserve money on it. Sometimes it's just a major upgrade, a remodel, a modernization, a resurfacing, right? So again, don't get too hung up on the word there. The scope of work is meaningful, but it doesn't always have to be a complete replacement. The main focus you want to have is what do you need to do to this component to keep it providing value to that association. Okay, so at this point, maybe you're wondering, how do we determine what belongs on that list, right? And I talked a little bit earlier about the Florida statutes and what they have to say with respect to reserve budgeting. But right now, what I'm going to do is give you a different approach. Okay, this is kind of the industry standard approach for how to define what is a reserve component. And we use a 4-part test for it. Now, the beauty of the 4-part test is that it can be applied to any different type of community. So instead of going into a project with some kind of predetermined checklist, the idea is to go in with your eyes open and look for anything there that meets these criteria. So I'll talk through these 4 parts one at a time. Okay, the first part is that the component in question has to be the association's responsibility, right? Seems pretty straightforward, but this is actually an important decision point. An example of something that would fail this part of the test in most cases would be the windows and doors in most condo buildings. It seems like it'd be at least 99% of the time when we look at the governing documents, the individual unit owners are responsible for replacement of their own windows and doors. So in those cases, there's no need to include any funding in the association's funding plan. It's not their job. If you've got an HOA where you have roads that are maintained by the city or by the county, obviously no need there to include any funding for road repaving. Okay, the second part of our test is that the component has to have a limited useful life. So in our world, we typically don't use the word forever, but if something should last indefinitely and there's no timeline where you would expect to replace something, then most of the time you shouldn't need to consider that in your reserve plan. So an example of that typically would be something like the foundation of a building, the structural load-bearing walls, the electrical conduit inside the walls, right? Things that should last the life of the property, however long that may be. Those are things you don't need to typically be funding for replacing. Okay, it's more likely at that point that a developer is going to come down and knock down the property and build something new than it would be that you're actually going to replace them. Okay, the third part of our test, I think, is maybe the most complicated, which is that the component has to have a predictable remaining useful life in order for it to be appropriate to include that in the funding plan. Now, the key word there is predictable, and to be even more specific, what I mean is predictability in terms of scope and frequency. So if you can't reliably predict how much money you'll be spending on something or how often, then it's probably not a good idea to handle it through reserves. Okay, let me give you an example. Many associations will ask a question, and this has been a big one the last couple of years. Can we pay our insurance deductible as a reserve expense, or can we include that for future budgeting purposes as a reserve component? You know, it's a really big number. If we ever have to pay that, we want to be able to draw from reserves for that. Now, the response from us is going to be, okay, well, I hear you, but what would the useful life be, right? In other words, how often will you have to pay that deductible? And of course, we don't know, right? That's the whole reason you have insurance in the first place. You know, those types of losses come as a surprise. It's the result of a natural disaster, a fire, a flood, a hurricane. And if we're going to make some arbitrary prediction about how often that will occur, we're kind of getting away from the point of this type of planning. Okay, now that's not to say we don't recommend that you should have some kind of plan in place, right? It's Florida. There will always be more hurricanes, more storms over the years. The problem is that we just don't know how often or how severe. And so there's really no way for us to responsibly, accurately tell a client how often they would be paying that deductible. So in that type of case, normally what we'll tell them is that, look, it might be a good idea to have some kind of third account for the association, right? You, like I talked about earlier, you have your operating account for your routine expenses. You have your reserve accounts for all the components that do meet these criteria. In addition to that, maybe it's a very good idea to establish some kind of emergency fund, or maybe an emergency line of credit that would be available to the community in the event that you need to pay for that insurance deductible. Okay, again, the problem with listing it as a reserve component is that ultimately we're basing some funding calculations off of a timeline of expenses. And if the expenses don't fall in line with the plan, right, then all of the resulting calculations will be off, right? So just kind of think this one through. If we just made a guess, let's say we assume a useful life of 10 years for paying an insurance deductible, that's implying that there's some predictable likelihood that there will be a major hurricane every 10 years. And we're going to assume that that's going to continue over and over again. But what if, like we're seeing on the Gulf Coast the last couple of years, you get a couple major storms in a very short amount of time? Now, if you're expecting that your reserve account can fund that deductible every single time, the reality is you're probably going to end up pulling money away from other components that did have a predictable lifespan. And that means you're kind of borrowing from Peter to pay Paul. You will end up needing special assessments to make up for those shortfalls. Okay, the last criteria on the test here is, does this component represent a significant cost to the association, right? Now, I kind of mentioned earlier the statutory number of $10,000 for condos. I want everyone to understand that's a pretty arbitrary number. There is no well-defined understanding of why the number is 10,000 and not 5,000 or 20,000, right? The point is, for most associations, that threshold should be a lot lower. And I'll tell you why. The advantage of setting that bar lower is that you will include more components as part of your reserve schedule, which takes the pressure off of the operating budget, which would otherwise have to absorb those costs when they came along. Right, so let's just think about some small association out there. Maybe they have 6 projects that are going to be $5,000 each. Technically speaking, they would be okay. They'd be compliant with the statute if they left those out of the plan, because individually they cost less than 10 grand. But that doesn't mean that they're going to go away entirely, right? Let's say that all 6 of those projects now happen to occur around the same time. 6 times 5, that's a total expense of $30,000 that they are now forced to try to squeeze into the operating budget, right? Where they could have listed those as reserves and planned and tracked for them that way, but by restricting that and leaving them just for operating, they're taking a little bit of a gamble there. Now, if their cash flow is a little tight, maybe they find themselves in a tough situation. But the advantage of having listed them in reserves is that now they can tap into that existing reserve money. Hopefully that's less disruptive to the community, less likely to impact the budget in a big way. Okay, that was a lot on that slide. All right, let's move on to this one, a little bit simpler here. On this slide, I've drawn a little red bracket there at the top, which is around the top 3 components. Those are the only ones specifically mentioned by the Florida statutes. Now, again, this is not counting this new SIRS requirements, but I think the point is I want everyone to look down the rest of the list here, and you will see a lot of the other components that we routinely include in a reserve study. Now, I know the statute, again, has that definition of what's over $10,000, but the problem we see is that not all associations, not all boards know what things cost, right? They don't know whether that should be on this list at all or not. So just to give you some idea for perspective, for a smaller, simpler, townhome style community, very often we might have 15, 20, 30 individual components on the list. But if we're talking about a big luxury high rise or some kind of complicated property, very easily we get 50, 75, even 100 or more components, right? So if you are in a high rise building out there and your reserve schedule has 8 line items in it, that's not enough. Okay, at the very least, that's not detailed enough. Things need to be broken down into much more granular detail there. All right, I'm going to switch over now to our second outcome of a reserve study, which is what we call that evaluation of current reserve fund strength, which we will typically describe in terms of something called percent funded. All right, one of the best ways that I found to explain this concept of percent funded is to use the analogy of a credit score. So hopefully everybody follows along here. We all have had our credit reports pulled. You generally know what your score is at any given time. And you understand that to an outside party like a bank or a credit card company, your credit score is an indicator of what kind of risk you might be, right? Now, in the same way, if you think of a reserve study itself, sort of like a credit report that needs to be distilled down to one key result, I think that should be percent funded. So we can measure that on a 0 to 100% scale and actually make some judgment about it, right? We consider anything between 0 and 30% funded to be a weak position. So in that range, associations will have a much higher likelihood of special assessments and other cash flow problems. When you get above 30% funded, now you're in kind of this fair range where the risk is more moderate, right? It's not an emergency anymore, but there's still room for improvement. Where you really want to be as a community is above 70% funded. That is where we have seen the very lowest risks of those types of financial problems occurring. All right. So that's the concept of percent funded, but now I'm going to talk about how do we actually calculate it. It's a fairly simple idea. Basically, all we're doing here is looking at how much money an association has at some point in time, and then comparing that amount against how much money it should have at the same point in time. Okay, just dividing that, showing it as a percentage. Okay, so the first part, how much money do you have? That's the easy part, pretty straightforward. We're going to look at the current financial statements, try to project ahead to the start of the next fiscal year in order to know how much money will be in the bank at the beginning of that year. So most of the work we're doing right now is for clients with a December 31st fiscal year end. We're looking at January 1, 2024, trying to figure out how much money will they have at that point. All right. Now, the second part of this fraction, how much money they should have, this notion, this concept of how much money they should have is something that we call the fully funded balance. Okay, now I'm going to try to explain this very carefully. The fully funded balance is a theoretical number, right? And the way that I like to put this in perspective is to ask you a question. Okay, so if I told you that there's some association out there that has $50,000 in reserves, but I haven't told you anything else about the community, is that meaningful? Have I really told you anything at all? And we hear this kind of thing all the time from our board members, right? Somebody might say, I think we're in great shape. We have, $900,000 in reserves, but we then need to point out that, that does sound like a lot of money. I'm sure it looks good on the balance sheet, but we have no way of knowing if that's adequate unless and until we have something to compare it against. Okay. So just think that through, right? $50,000 for a, little 2-story building with no amenities, just a parking lot, maybe 50 grand is plenty of money for them. But if we're dealing with a big luxury high-rise property, right, $50,000 is, barely a drop in the bucket. That can be wiped out in one installment of one project, right? Painting a building like this might be $1 million all by itself. So everything needs to be scaled appropriately to what type of property we're talking about. And this is where the fully funded balance is a very helpful tool for that. Okay, so how do we actually calculate this number? It's a fairly simple idea, I think. Basically, we do it on a line-by-line, component-by-component basis, and then add all those figures together. So first thing to do is look at each component and see how old it is compared to its overall lifespan. That'll give us a fraction. I then multiply that fraction by the current estimated cost of the component, which tells me how much money that client should have today for the eventual replacement of that thing. Okay, so when we do a reserve study, we're going to go through this line by line. Doesn't matter if they have 4 components or 400. We're going to calculate the individual fully funded balance for each of those line items and then add those together, which tells us the fully funded balance for the entire association. So once we've done that exercise, now we have something to use. We have something to compare against their actual cash on hand and put that number in perspective. All right, so just to hammer this home, let's do an example together. So let's all pretend that we're on the board now for this, this property we'll call Seaview Condominiums, and we want to calculate percent funded for our association as of the start of next year. Okay, pardon the typo there, that should say January 1st, 24, but you get the idea. Now that we understand a little bit about percent funded, remember the first thing to do is to establish the starting reserve balance for the upcoming year. Okay, so if we know how much is going into the account between now and then, how much we're going to spend, let's say we've done that math, we're going to end up with 60 grand in reserves going into next year. The next thing we're going to do is calculate the fully funded balance for each component of the property. And for the sake of this example, I'm going to limit this to just 3 things. First one, we'll look at the roof. Okay, let's say the roof is 10 years old and has an overall useful life of 20 years, and let's give it an estimated replacement cost of $80,000. Okay, so keep in mind that the fully funded balance for the roof is only the proportion of the cost that they should have on hand today. So since it's halfway through its life, we only really need to have half of the replacement cost saved up today, recognizing now that we have another 10 years to collect the difference. Okay, so in this case, we'll take 10 over 20, multiply that by $80,000, which tells us that the theoretical fully funded balance for the roof as of right now is $40,000. Okay, again, it's halfway through its life, halfway, so we should have half of the replacement cost saved up. Okay, our next example, let's say we're going to do this for the gym equipment, right? Now let's say that it's 5 years old and has an overall useful life of 15 years, and let's give it a replacement estimate of 30 grand. We should know now that the fully funded balance for this equipment should be $10,000, right? Makes sense. Again, 1/3 of the way through its life. So theoretically, Seaview condominiums need to have about 1/3 of the replacement cost in the bank today. Okay, we'll do one more. Let's say that we have painted the hallways of the building 2 years ago, and the plan is to do that every 8 years. Let's say the cost is 100 grand, right? So we're going to take 2 divided by 8. It's 1/4 or 25% of the way through its life. At an estimated cost of 100 grand, the fully funded balance now should be 25,000. Okay. So going back to the concept of percent funded, now we have established our starting reserve balance, and we've calculated those individual fully funded balances for each component. And that will enable us to calculate percent funded for the entire association. Okay, it's going to look like this. We take the 3 numbers that we just calculated, right? The 40 grand for the roof, 10,000 for the gym equipment, 25,000 for painting. Adding those together, I get 75,000. Remember, we estimated that we will actually have 60 grand in cash. So 60 divided by 75 means that Seaview is 80% funded. So what does that mean? Overall, that's pretty strong, right? We said anything above 70% is generally good, but there is maybe some room for improvement there. They might have to start accelerating their contributions a little bit. Okay. So before we move on from this section, I want to show how we can begin to draw some financial conclusions about associations based on these levels of percent funded. So what you're looking at, excuse me, what you're looking at on this chart here is the result of a very large internal analysis that we completed a number of years ago. What we did here is we looked at a data set of thousands of associations, and we measured for 2 different variables. First of all, what was their percent funded level? And then secondly, yes or no, did we need to include any special assessments in their funding plans? Okay. Now the results were pretty obvious and consistent with what we had thought they might be. Basically, the closer an association is to 0% funded, kind of the top of this column right here, the higher the chances they will need immediate special assessments to get off the ground, right, to cover some of their near-term projects. They have very little cash on hand, and especially if they have things that are at or near the end of their useful life, there's a very good chance that they will not be able to get there through regular budgeting. They will need special assessments to cover the difference. Okay, a couple years after that first one, we did another internal study. This time we wanted to see whether there was any correlation between percent funded and actual property values of the homes in these associations. So this one was a little more precise. What we did here is we looked at one data set from one metropolitan area, basically greater Los Angeles, California. And we selected a group of properties that were all as similar as they could be in terms of their size, their age, their amenities, and so on. We then measured the appraised market value of the homes in those communities. And we wanted to see, is there any difference, any noticeable difference when the associations themselves are in a better financial position? Okay, so to be specific, would we see any increase in property value for associations that are in a better financial position with respect to percent funded? It's pretty interesting analysis. The first thing we did was to establish this kind of baseline, right? So we defined the baseline as those associations that are in that weak, 0 to 30% funded level. We then looked at what happened to property values for comparable associations when they were in a fair position, in 30 and 70% funded. Now, what we found is that the communities that are in this fair position compared to their weak counterparts, property value jumped up about 8%, right? So the homes in these communities were 8% more valuable on average than the associations that, again, are comparable in almost every other way. Even more interesting than that, the ones that were in the strong position above 70% funded saw almost a 13% gain over the ones in the weak position, right? Now, why is that? Well, I think there's some intuition here. The associations that have money in the bank tend to have better curb appeal, right? They're in better physical condition. I think that translates back to them being more attractive to potential buyers, right? If you go into a community and the first thing you see is the paint is peeling and the parking lot is a mess and the gym equipment is 20 years old, as a prospective buyer, that's not very impressive, right? And all of those things are very typical of associations that are weakly funded. They don't have enough money to do projects on time, right? So again, one of the fundamental questions of this whole exercise, why should you have reserves at all? Well, one answer is that can come back to you in the form of higher property values. Okay, just a few more slides here, then we're going to go to our Q&A. So again, I see some questions already in there, but if you want to start populating those additional questions in, now is a great time. We're going to switch back though and talk about the third and final outcome that you get from a reserve study, which is the funding plan. Right, so if you think about the first two things, we talked about the component list, which is essentially defining what you're reserving for. We then talked about percent funded, which tells us where the community stands as of a particular point in time. Once you know those two things, though, the last question to answer is, well, where do you go from here? Okay, so one of the first things that we do when we're doing a reserve study, when we're designing that funding plan, is we will look at the current budget and just try to see what happens if the client stays on that track, right? If they didn't change their current budget and they did the same thing the next year and the year after, what happens, right? Will that be enough to cover their future expenditures? And if it's clear that that current plan is not going to be sufficient, then we have to recommend some changes, okay? Two other points to make here. I think this question came up actually in an email, which is about the timing of reserve contributions, right? So I want to make it clear that the funding of reserves needs to be consistent with the timing of your overall assessments, right? If you have monthly dues paid to your association, there needs to be a monthly reserve contribution. I believe by law that has to be within 30 days. In other words, what you cannot do is that you're just going to wing it and operate all throughout the year, hoping, kind of like our guy in the beginning with his fingers crossed, hoping that at the end of the year, maybe there's some surplus in the operating budget, which you can then transfer over to reserves and say, hey, look, we funded our reserves that year. It doesn't work that way. It needs to be a proactive, ongoing contribution, right? Now, the last point to make on this slide is that in cases where historically the reserve contribution rate has not been sufficient and that association is really far behind, unfortunately, there might need to be an initial special assessment that's included as part of that plan. Now, when that happens, and I think this is a very important point to make, it is, I think, appropriate to think of a special assessment as basically a catch-up contribution that's being made to make up for some number of years of insufficient funding that came before it, right? There's almost nothing special about it. It's just the inevitable result. If you're waiving reserves each year, if you're doing the bare minimum, it should not come as a surprise that one day when you need to pay for something very expensive, you're going to need a special assessment or a bank loan to cover that cost. Okay, couple of key principles that come into play when we're designing a funding plan. I'll talk a little bit about each one of these individually, but I want to focus on the last one. And again, some of these topics are things that we cover in much more detail in our reserve funding methodologies course, but for now, I'll just highlight some important details here. Sufficient cash in this context means that you can never design a funding plan that has you running out of money. Seems pretty obvious, but we're looking out typically a 20 to 30 year forecast into the future. We will model out when these expenditures are taking place. And at the very least, you need to show that your cash going in will be greater than your cash going out, right? There's never any fiscal year where you go below zero. Okay, that rate should be fairly stable. One of the nice things about the new legislation we have in Florida is that they wrote into the new bill that the reserve funding contributions may be adjusted annually for inflation. So that's very important. Your reserve contributions should be going up each year for the very basic reason that the costs of those things tend to go up each year, right? Usually we'll assume something like 3% inflation in our studies. And so that follows that your reserve contributions should also be going up by something like 3% to keep pace with that. Okay, your reserve funds are distributed amongst all of your components, right? So what that means is we don't take years off, right? Even if you've just painted your building, something like 7 years later, you're going to need to do it again. So you immediately start funding for that next round as soon as the prior one is done, right? Everything is funded all of the time. Now, the last part here about being fiscally responsible, I'm gonna dwell on that for a moment. I think this is maybe the most important principle to follow when you're designing your reserve funding plan, when you're working on this as a budget. What do we mean by fiscally responsible? Well, first of all, it means being realistic with respect to interest and inflation. I just talked about inflation a little bit, but let's talk about interest, right? It is not realistic to assume that you're going to earn 10% interest each year forever on your reserve funds, right? You would be a Hall of Fame stockbroker or trader if you could do that. We just know that reserve money can't be invested in anything very exciting. So that means you should be assuming a fairly low return on those funds, especially over the long term. Okay, again, with respect to inflation, be realistic. We found that looking at historical data trends, when you zoom out over a long enough period of time, very reliably, your average annual inflation rate tends to be about 3%. Okay, so if you're assuming that the cost of a project 15 years from now will be the same as what it cost you today or what it cost you last time, that's probably going to be way off, right? That plan will not work. That will not survive. The second point on this slide speaks to being honest about the situation that you're in, okay? If your association has not historically done a good job of funding the reserves, it's critical to address that, right? It's just financially irresponsible to continue operating the way you always have just to try and maintain some kind of status quo. Okay, it's not the job of the board of directors to make the owners happy. It is not their job to keep the dues low compared to the building next door, right? Speaking of the owners, the reserve funding plan cannot be biased in favor of the people who live there now at the expense of the people who live there later on, right? We see that all the time, right? You can't assume that there will be some group of owners in the future who will be perfectly happy to pick up the tab for all the deterioration that is happening now while you live there. Now, lastly, and maybe not so obviously, this all takes place despite what may have happened up to now, right? We see this all the time as well. Prior budgets ignored reserves, we're underfunding them. The association has had the can kicked to them by all the prior generations of people. That's not an excuse to kick the can on down the road for the next group, right? In a perfect world, of course, all associations would have been doing this correctly. They would have had good management, made good decisions, They would have been guided over the years to some kind of stable financial position, but very, very often that's not the case. However, that does not in any way remove the obligation from the board of directors to act responsibly and to fulfill that fiduciary duty. So, all right, that brings us to the end of our course material. Paige, if you're with me, I'm going to kick it over to you and have you help me with the Q&A. As I do that, I'm going to turn my video back on, and I've still have my screen shared up here. If you want to take down my email address, if there's anything that I don't cover today, please feel free to send me an email, and we'll do the best we can here. So, Paige, while you do that, I'm also going to launch the poll, and people should see that momentarily. Okay. All right, so that's now live. Paige, you want to kick things off for us?
Yeah, absolutely. All right, let's go ahead and take a look at these questions. All right, well, we'll go ahead and start with the question at the top here. Can regular reserves still be used for maintenance that extends the life of the asset by at least a year?
Yes. So again, some of these questions are going to be contextual. I'll do my best to try to read between the lines and answer them as best I can. But yes, if you have reserve money for reserve components and you're going to spend money to extend the life of something, let's say you're going to replace the radiator on a generator for the building, that will therefore extend its useful life for complete replacement, then I would say yes, that's not a problem. Yeah, I mean, always, and again, I'll restate it again. I'm not an attorney, so this is not legal advice. If you're on the fence about something, always good to check. And I haven't, by the way, also haven't seen any of these questions before, so I'm going to do my best to answer them as quickly as we can. But yeah, keep going.
All right. Is it permitted to move non-statutory funds to other line items in a straight line method of reserves without a member's vote?
Well, yeah, let's think about that for a second. So if you have straight line reserves, meaning what we call component method reserves, and that money is locked up in various accounts only to be used for specific things, then generally speaking, you're not supposed to move money from one place to another without a vote of the owners. They consider that a non-scheduled use of reserves, something we talk about in great detail in our other class. But the key word in this question, I think, is non-statutory. So if you're in an HOA, you can have statutory or non-statutory reserves. Most of the time, the reserves are considered statutory, which means they were either initially provided by the developer or a majority of the voting interests have voted to formally create a reserve fund. If either of those two things have occurred, then you have statutory reserves, and I do think you should probably have to get that member's vote. On the other hand, if they are non-statutory, meaning the board themselves have just kind of voluntarily created a reserve fund, then there may not need to be any vote of the owners there. So a couple of caveats to that one, but if you're not sure, I would assume that you probably do have statutory reserves, and that one only really applies to HOAs anyways.
All right. How do you handle the massive component or cost increases over the last 2 or 3 years? As an example, painting and weatherproofing of a mid-rise condo has increased by 60% or more over the last few years. How do we plan for this?
That's a great question. Yeah, it's been a very difficult thing in their industry, really, for any association out there, not just painting, but a lot of mechanical equipment. Things that were disrupted by the supply chain issues during COVID have really not come back down to their pre-pandemic levels, let's say. There's really not anything, unfortunately, that you can do to plan for something like that. All you can really do is react to it and adopt a new plan accordingly, I guess. Seek out estimates, right? If it's been a couple years since you've done a major project and you're worried about what the new cost might be, go out and get some estimates and use those in your current budgeting. That's what we're doing in our studies. We're constantly getting new data points and seeing real world changes in the market to see what things cost now, and then having to just recalibrate. And unfortunately, that's meant that some of our association clients have seen pretty substantial increases in their reserve funding requirements. That's just kind of the way it is, unfortunately. We are reacting to what we see in the market. And when the market has jumped up in a big way for a cost, we need to incorporate that into our new plan. So I think it's all the more reason why when you're doing a funding plan, you want to be extra conservative. You want to maybe aim high, have that extra cushion there in reserves. Don't try to adopt a baseline funding plan, which will leave you kind of living paycheck to paycheck. So yeah, it's an unfortunate reality these last couple of years. I don't think anybody could have seen that coming. The best thing you can do is just make sure that you're adopting on the fly and using the latest and greatest cost that you can. And hopefully in the future, things will come back down. We'll see.
Adding on to that question, Will, how can we estimate the cost of something that is going to happen 8 or 10 years from now?
Mm-hmm. Well, the way that we do that is we look at the current cost. If you had to do it now, what is that price? And then when we model something into the future, we will assume some percentage of inflation to try and estimate what it might be in the future, right? So that's where that average of 3% inflation usually is pretty reliable. But if you're looking that far out, I think the really important thing to mention is that you shouldn't be just sitting on this one estimate and assuming that you're going to be right. You need to update that plan very frequently so that as time goes on and costs change, you kind of course correct each year, right? So this is why associations need to do a budget each year, and they need to prepare a new reserve schedule each year. You don't necessarily need to do a new reserve study each year, but this is the way that you would capture that. If you're thinking about something 10 years from now, you come up with your best estimate for what it is now, model in some level of inflation, and then next year, the year after, 3 years later, you fine tune that. Call up your painting contractor again, say, hey, you gave me a quote last year, what would it be now? And then you adopt from there. Especially for your big ticket items, that's very important to do.
All right. Can HOAs list insurance deductibles as part of their pooled reserves?
Technically speaking, associations can do it. What I try to explain is that it's just not a good idea. It's not illegal to list a insurance deductible as part of your reserve funding plan. Again, the problem is that we don't have any real reliable, good way of estimating the useful life for that. So that's why I suggest that clients or associations should have an emergency fund or line of credit for paying for that. Because if you just make a wild guess on the life expectancy of something and you're wrong, that kind of blows up all the other calculations in the plan. So again, it's not illegal, but it's not advisable to list insurance deductibles there.
Do we need to do the repair or upgrade on the year scheduled in the reserve study, or can we use the money sometimes later?
Really good question. Yeah, so a reserve study is not a mandate telling you when you must do something. Okay, it is a budgeting tool that tells you the approximate time when you should be financially prepared to do something. So if we come in and we say that, look, your cooling tower on your building has 0 remaining life expectancy, that's probably based on the age and the condition of it, the fact that it is maybe very likely to fail in the near future. But if it's still working, if it's still doing its job, you don't necessarily have to go out and buy a new one just because your reserve study said it had a remaining life of 0. What it means is you should probably be ready to do it because there's a chance it's going to fail at any point, right? So I'll use this analogy a lot of like an old pickup truck, right? If I have a truck that has 250,000 miles on it, but it still starts up and I can drive to work and back every day, nobody would tell me that I must go out and buy a new one. But I think somebody who's kind of seeing the writing on the wall would say, look, one of these days you're going to go out to the driveway and turn the key and nothing's going to happen, right? And it's not worth the cost of trying to repair it at that point. You're better off just buying a new truck. And so from a financial planning standpoint, I should be smart to have that money set aside and ready to go. But it doesn't create that mandate that says a board must go out and spend this money.
What is the recommended minimum reserve fund balance in any year as a percentage of the total value of all reserve component costs?
Good question. But I think I would improve that by saying you want to just do it as a percentage of the total fully funded balance, right? So if you look at the total replacement costs of all of the assets of the property, you can total that up, but it's not really meaningful because you don't replace everything all at once, right? So let's just say you totaled everything up, it might be $50 million, but you would never spend it all in one shot. So basing a number off of that calculation is not as good as looking at the individual fully funded balances of each component and then coming up with a level of percent funded around that. Because that's, again, that's going to be the proportional amount based on the ages of the components. So, I guess to answer the question, then we can go back to what we consider, weak, fair, and strong. I would say you want to try to stay at least above 30%. Anything above 30% is fair or strong, and you're going to have a much lower likelihood of special assessments if you stay there. But again, it's not based on the total replacement cost. It's based on the percentage of those costs, proportional percentage of those costs.
Okay, if we wanted to build a new amenity that costs $200,000 with a 10-year useful life, how would we fund that? Would we add a line item, then once the amenity is built, we would then add it to reserves?
Exactly. Yeah. So the example I use in the course is the playground, right? If you want to build the playground, go ahead and do that, but you can't spend your reserve money that you've collected for other things for that new project. Once it's done, though, and you've got this brand new beautiful playground, by all means, then you need to add in allowances for future repairs and replacement of the equipment, the fencing, the shade structures, the fall surface, whatever you have there. Those now can become reserve components. It's just that initial construction project that is not.
Okay, we have time for one final question. We had a lot of great questions come in. As a reminder, in 2 months, so November, we will have that Ask a Reserve Specialist. We could probably will look at some of these questions and add them to that, right?
Yeah.
For that session. So be on the lookout for that email to sign up for that webinar when it is time. Last question here, Will. What are the major differences between a reserve study and milestone inspection / study?
Sure. Sure. So a milestone inspection is a new requirement that came about as the result of Senate Bill 4D and then the successor Bill 154. And the milestone inspection is basically just a structural evaluation. It's required for condos and co-ops that are 3 stories tall or more, and it's all over the state, right? So up until now, we've had a similar requirement in Dade and Broward County, which was for something called a 40-year certification. And the 40-year certification is just a structural and electrical evaluation. It has nothing to say about really any other parts of the property. But it goes into great detail with respect to those things. So a milestone inspection, I guess you could say it's narrower in scope. It's not looking at mechanical systems. It's not looking at amenity areas or any of the other major things that we put into a reserve study. It is just structural. They need to be done. It's every 10 years now. The first one is due at the 30th year of the building's age. So, reserve studies are different in a couple big ways. You need to do reserve studies earlier and more often. They are broader in scope. We include structural things, but also mechanical systems, amenities, all the other stuff. And they're done for different reasons. I mean, a milestone inspection is kind of a looking backward focus based on the age of the building. A reserve study is a proactive budgeting tool that you do early and often in the life of a building so that you take care of it and hopefully you don't encounter those big structural problems. So they there's a little bit of overlap between the two, but they are 2 different things. I have a lot more to say about that in our SB 154 overview, which we can send that out as a recording as well. So yeah, otherwise, looking over the list, lots of other good questions. Apologies that we couldn't get to them. We're out of time for today, but I do want to thank everybody for joining. Thanks for filling out the poll. Paige, any other final comments that you have?
No, like you said, we'll include the link to the SB webinar in the email that I'll send out. That will include certificates of completion and the slides. So that will go out within a week.
Okay, sounds good. All right, well, everybody, thank you very much for joining us. We do appreciate you, and we'll see you for the next one in a month or 2. So thank you very much, and until then, thank you. Bye-bye.